So the question is, a corporation uses net present value techniques in evaluating its capital investment projects. The company is considering a new equipment acquisition which will cost them $100,000 fully installed and have a zero salvage value at the end of its 5-year productive life. Okay. So they are considering to buy a new equipment, it seems, which will cost them $100,000 and it will have a zero scrap value if it is used for 5 years, and it will have a productive life of 5 years. Corporation will depreciate the equipment on a straight line basis for the financial and tax purposes. For both purposes, it's the same. Corporation estimates $70,000 in annual recurring operating cash income and $20,000 in annual recurring operating cash expenses, right? So you can gather the information. The corporation's desired rate of return is 12%, and the tax rate, effective tax rate, is 40%. They're asking you what is the NPV. I think this question you can easily do, Samrin, right? Will you
Yes,
start
yeah.
or shall I explain?
I'll start.
Yeah, okay. So meanwhile, see, we can discuss simultaneously. See, the investment is $100,000, right?
Yeah.
That's at the zeroth period. What is happening here? First year 70,000 minus 20,000. It's 50,000, right? The same thing
Yes.
is happening every year, correct?
Yes. For depreciation, the equipment
Sorry.
minus 20,000 is
This is like recurring operating cash expenses.
okay. Okay.
Yeah, there is a income minus expense, right?
Yes.
Yeah. And this is what, then you have this depreciation also. So we will be, the 70,000 is the inflow and 20,000 is the expense, right?
Okay. Yes.
And like this is what, but the problem here is they have given you 70,000 as cash income. Okay. And this is your expense. What about depreciation? How much is the depreciation?
20 20,000.
Just a second, Samir. Just a second. Yeah, so 50,000 is the inflow every year, right?
Yeah.
So what we will do is, this inflow here they have given cash income and they have given cash expenses, and they have given the depreciation. So $100,000 divided by 5 will give us 20,000. This is the depreciation, right?
Yes.
And like so this is 20,000 we are getting depreciation, right? So the role of depreciation would be tax allowable depreciation. Corporation will depreciate the equipment on a straight line basis for both these purposes. NPV. So definitely depreciation, if we are taking into 20 into 40%. So 8,000, right?
Yes.
Hello?
8,000. Yes, sir. Hello.
Yeah. 8,000. And next part would be, is it 8,000 or like, yeah. And this is what is my like, I can say this as what, 8,000 as my TAD, right? Cash savings from TAD. Can I say this?
Yes, sir.
It is annually the same amount, right?
Yeah.
Correct or wrong?
Yes, sir. Correct.
And this is my cash like flows every year into 60%. I will remove the tax.
Yes.
Okay, see, if I take 40% and if I subtract, I get the same thing. If I take 60% and directly multiply, I get the same thing, right?
Yeah. 30,000.
30,000. So 30,000 and plus 8,000 is the cash flows every year I have, that is 38,000, right?
Yes.
Any doubts in this?
No, sir.
Yeah, so the points are very clear. 70,000 was my income, 20,000 was my expense. I just subtracted and I got the net cash flows. Of that, I've taken 60% because 40% I have reduced or it goes for taxes. So
Mm.
30,000 is the net cash flow
Ah,
after tax.
that's
Yeah, cash flow after tax, I can say. And this is the cash savings from tax allowable depreciation. Okay, or depreciation tax shield, whatever you want, you can say. That is like 8,000. So 30 plus 8, if I add, I get 38,000, right? Now,
yes.
yeah, so 38,000. Now, the 12% is the tax, is the cost of capital, right? Now, this 12%, what we can do, since the cash flows are 38,000 for every year for the next coming 5 years, can we take the annuity factor? So, 38,000, I'll just put it here. 38,000 into present value annuity factor at the rate of 12% for 5 years. Can you tell me from the table what is the factor? If I'm not, I'll put the factor. The factor is 3.605. Okay.
Yeah.
So,
Yes.
hello?
Yes, sir.
Yeah, so 38,000 into 3.605 I will take, and it will be around 1,36,990. My initial investment has been $100,000. So what is my NPV? 36,990. Okay, this is my positive NPV and this is the answer. Please like make a note of all this. I'll move forward.
Yes.
Shall I scroll down? Whatever, wherever you can say, I'll just scroll up also. Inform me if Samarin when done.
Oh, done, sir.
Yeah. So the technique that incorporates the TVM by determining the compound interest rate for an investment. So the technique which incorporates the time value of money by determining at what rate the present value of cash inflows will be equal to initial investment. Can I say that is IRR?
Yes.
Next.
Pre- okay.
Hello?
Yes, sir.
Yeah. So go for the next question, somebody. So Jorel Company's financial staff has been requested to review a proposed investment in new capital equipment. They want to invest. That means they want to buy a capital equipment, it seems. Applicable financial data is presented below. There will be no salvage value at the end of investment's life. And due to realistic depreciation practices, it is estimated that the salvage value and net book value you'll be getting after deducting the depreciation, are equal at the end of each year. That means the scrap value and the net book value, whatever the net book value and the scrap, it is almost the same, it seems, right?
Yes.
So that means after deducting the depreciations, whatever leftover value is the scrap value, it seems. The book value which is leftover is equal to scrap value. All cash flows are assumed to take place at the end of each year. For investment proposals, they are estimating the returns to be 12%. That is after tax target rate of return. Understood fact? They have given you the investment proposal here, the purchase cost, the annual net after tax cash flows, and the annual income. Okay. So purchase cost, year initial stage, and the book values are given to you. After tax net cash flows are given to you. Annual net income is given to you. So now you already know what should be your consideration, right? You should be considering what you already know. Cash flows are the ones which are the relevant ones for the discounted cash flow techniques. Am I right?
Yes, sir. After tax cash.
Yeah. So this is, yeah, after tax cash flows are directly given. So to find out NPV, what we need to do? We need to directly discount them, right?
112%.
At the rate of 12%. This is not relevant. This is not relevant.
Yes.
So you have like present value $1. We don't want annuity because these are all the cash flows are not equal every year, right?
Yes.
So hopefully if I'm not wrong, you'll be multiplying with 0.89,
8,
0.80, 0.71,
yes, yes.
0.64, 0.57, right?
Yes.
Just multiply and tell me.
Okay.
What is the investment? I think
Two,
it is 250,000, right?
yes, sir. 2,50,000.
It will be one itself, yeah. So you need to multiply and tell me the present value of all this cash flows.
Okay.
What is that? You tell me. I'll put the figure here and we'll subtract 250,000 from that. We'll get the NPV.
Okay.
I'm waiting. Yeah.
Hello.
Yeah.
First year, 10 lakh 6800, 1 lakh 6800, 8,6400, 8 lakh 64. Okay. 68,
86,400.
68,160, 53,760, 41,040.
So when you add all this, what's the answer?
3,56,160.
Yeah, just a second. 60. 3,56,160 minus 250,000. It's like 1,06,160, right?
One.
Yeah, this is your NPV. Is it so? Yes.
Yes, sir.
So shall we move forward now?
Yeah.
Go for the next question. So a corporation is considering the acquisition of a new technologically efficient packaging machine at the at a cost of this much. So they want to buy a machine. The equipment requires an immediate fully recoverable investment in working capital of 40,000. See, as you know, capital budgeting or investment decisions topic is such whereby if you invest your money into some project, definitely some working capital is required to run the daily affairs of the like company, or daily routine transactions have to be met, or daily routine expenses, or whatever the financial obligations they have to be met on daily basis, and for that they require working capital, right?
Yeah.
So this working capital is recoverable working capital. That means they have to recover this at the end of the project's life. Now we will see till what time the project will run. It is like, for 5 years. So corporation plans to use the machine for 5 years and is subjected to 40% income tax rate. And there is a 12% like hurdle rate when analyzing capital investments. The company employs the net present value to analyze projects. So now the overall overall impact of working capital investment on corporations NPV analysis is what they're asking. So now you should be trying this. So I will tell you how to go about this question. First of all, 40,000 is the working capital which is recoverable, right?
Yes.
See, first of all, when you started the project, 40,000 you invested, correct?
Mm.
This 40,000 when you invested in the at the initial, see, at the initial stage, there will be an outflow of cash regarding the investment, that is 300,000, correct?
Yes.
And as well as that is the zeroth period. There will be also an investment in working capital, 40,000, right?
Yes.
So if I take up the discount factor, it will be into 1 for the first year. But in the fifth year, I'm speaking about fifth year. Fifth year, this 40,000 is recoverable, right?
Yes.
So into what is the fifth year discount factor for 12%? 1 by 1.12 whole power 5. Can you tell me the factor? I would say 0.567. Multiply this 40,000 with 0.567.
22,680.
So this is the investment you have done, and this is the recovery you have made, right?
Yes.
So this is the PV of recovery. This is the PV of working capital investment. So we will see the net overall impact on the corporation's working capital. Okay. So
Okay.
like as on today, do you 22,680 you are recovering, you are investing 40,000. There is a decrease or increase?
Decrease.
Decrease of how much?
17,320.
Yeah, because nothing like what you have invested, you haven't recovered, right? As on today, if I
Yes.
see, correct?
Yes, sir.
In fact, less amount has been recovered.
Mm.
So what is the answer? 17,320.
320.
Just make a note of this.
Done, sir.
Can you answer the next question, Samrin?
Uh, C. Computed IRR.
How? See, this is NPV method, right? They
NP,
always think that discount rated NPV calculation only, cost of capital.
NPV
IRR
can.
assumes at IRR assumes at IRR.
Yes.
So this,
NPV assumes reinvestment in NPV only.
yeah,
Discounted.
yeah, of course.
I I
We
think you said
discussed many.
IRR.
No, 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 never. IRR is separate method. NPV is separate method.
Okay. My mistake.
Yes,
Sorry.
the reinvestment assumption is like here always at cost of capital, discount rate. Whatever the positive NPV you get, you can
Hmm.
reinvest it at this particular rate, right? NPV,
Yes. Yes.
discount rate which is used in NPV. Again, the same question which we have already discussed, but they are asking something else, or what they're asking, we'll see. The accounting rate of return on average investment proposal is. So, what is the formula for accounting rate of return? So for
Yes.
accounting rate of return, the approach will change, right? You have to take the annual net income, correct?
Yes.
Hello.
Yes, sir. Listening.
Yeah. So accounting rate of return is nothing but the average income whole divided by average investment. Okay,
Okay.
right? Accounting rate of return. So we will do the average of incomes. Can you do the average of incomes? You can take this five incomes and divide by five.
Hmm.
What you're getting, you write it here, and your investment is this, right? So
Yes.
250,000 divided by 2. What
Yes.
you're getting, you tell me. I'm waiting.
Total of income divided by 2.
No, average income, right?
Yes. 5 years income
Average
divided by.
income by average
Oh,
investments.
okay, sir. Just a minute. I'll come back.
Yeah, yeah. Hello, Samrin, you're doing? Hello? Hello?
Hello. Hello.
Hello.
Yes, sorry.
Finished?
Yes, sir. Finish.
Hello.
Yeah, hello.
Yeah, yeah. Finished. What's the
Yes.
answer?
For income,
What is the like average income?
average income is 1,75,000.
How? You have to add all this and divide by
Yeah,
5.
add all this but divided by 2 or 5.
5. These are 5 years incomes, right?
Yeah,
So the average is sum of the
43,000.
observations by number of observations. Yeah. How much?
43,000.
43,000. So put it here
Mhm.
and then you can divide by 125, right?
Yes.
What's the answer?
0.344.
34.4%, right?
Yeah, right.
Okay. Go for the next question. So the next question is companies considering 4 alternative opportunities, right? Required investment outlays and expected rates of return for these investments are given below. So they are considering 4 alternatives. Either they want to take up the project A or B or C or D, any of them. And the details are given as the investment cost and the internal rate of returns are given. And that means this is the rate at which the project will break even, right?
Hmm.
Now, investments will be financed through 40% debt and 60% common equity. Just a second, Samrin, just a second. Yeah. So the investments will be financed by, this is the capital structure they have. Internally generated funds totaling this much are available for reinvestment. That is their retained earnings. If the cost of capital is 11%, company, this is 11%. Okay, that means this is the required rate of return what they have. Company strictly follows the residual dividend policy. That means leftover amount they will give for dividends. Okay, after meeting the obligations. How much in dividends would the company likely pay? So you can read the question once again. We'll solve. See, it's a very simple question. Actually, not a big deal. Okay. See how much they have funds. They have this much funds, right? They have $1 million. So residual dividend policy is nothing but they clearly are saying investments will be financed through 40% debt and 60% equity. So we are concerned with this, and they have this much funds available for reinvestment. That means they will be using the money out of this for investment purpose. Correct?
Yes.
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 So they will invest in which projects? They will definitely invest in the projects which are giving more than 11%. This is what they want, right? And these projects are giving them more returns, right? Yes.
Yes.
These are the returns which they are getting, correct? From all the projects. Above that, anything they won't accept. Below that they can accept, correct? Hello.
Yes, sir.
So anything above this here is all acceptable. So they won't go for this. Can you add these particular figures and tell me what's the total? 550 plus 570 is 1120, right? Correct.
Yeah, right.
But this is the investment they will do, but they want only 60% of this. Okay, because they can only use 60% of this only can be funded through equity, 40% has to be funded with debt
Right.
finance. So how much is that 60%? 60% of this, can you tell?
6,72,000.
6,72,000. So that we will take. So that 6,72,000 can they take from this? What they have? And the balance amount they will pay us dividends.
We
Okay,
have to indeed. Yeah.
that's it. That's the residual policy. Whatever is left over will go for dividends. You want to note this down?
Yes, sir. Scroll down, sir. Done.
A disadvantage of NPV method of capital expenditure evaluation is that it. Do you think it provides any rate of return for you? No. It only tells you about the positive or negative NPV, right?
Yes.
This is the answer. Next. 34th. Company is considering, you have to go through this. So a company is considering a project that calls for an initial cash outlay of $50,000. The expected net cash flows from the project are this for the 10 years. What is the IRR? So this IRR calculation you can do, right? So I will tell you how to go about that IRR calculation very simply. See, how much is the investment?
50,000.
What is the IRR concept? IRR is nothing but the cost of capital at which
NPV is equal to 0.
the initial investment is equal to present value of cash inflows, right? Yes.
Yes.
So 50,000, that means the present value of cash outflow should be equal to present value of cash inflows.
Yes.
So present value of outflow is equal to present value of inflow. So 50,000 is your outflow. See, your cash inflows are going to be 7,791, right? Hello.
Yes, sir.
Into, see, these are equal cash flows, right?
Yeah, for each 10 years.
Yeah. So present value annuity factor at the rate of, we will get that. So present value annuity factor for 10 years we will find, right?
Yes.
So 50,000 divided by 7,791 can give me that factor or not?
6.417 I got.
6.417.
7.
Okay. So now you have to go to the annuity table,
Mm.
which is there in your textbook backside. 10 years, 6.417 lies at what discount rate? If you can tell me, I'll put the answer. This is
It
the
lies at
6.417 annuity factor for a period of 10 years. At what is the discount rate? Are you seeing?
yes, 7% and 8%.
7 and 8.
10 years.
Yeah, 10 years. Actually, 9% it should be.
Mm,
6,418,
Yeah.
417. Sorry?
9%. 6.1418.
Yeah. Actually, you'll get that only because it will be going on, going on, going on. 7, something will be there.
Mm,
So 8, 9%, right?
8.
Shall we move forward?
Yes, sir.
Hello?
Yes, sir. Just a minute.
Yeah. 35th question. So a company invests in a project with expected cash inflows of 9,000 per year for 4 years. All cash flows occur at the end of the year. Required rate of return is 9%. If the project generates an NPV of 3,000, what's the amount of initial investment in the project? So you have to find out the initial investment, right?
Mm,
So what we will do for that is we have to go backwards, correct? Yes.
Yes.
See, hello.
Yes, sir.
See, I'll tell you. NPV is equal to present value of cash inflows minus the present value of cash outflow, right?
Mm,
I will bring this here. I'll take this here. So present value of cash outflow is equal to present value of cash inflow minus NPV. Correct or wrong?
Correct.
So present value of cash inflows 9,000 I will take into present value annuity factor at the rate of 9% for 4 years will do. So what is that? 9,000 into 3.240, correct?
Yeah.
So how much that will be? 29,160. So
Mm.
29,160 minus 3,000 will give you that answer, and that will be 26,160.
26,001.
Yeah.
Yeah.
Okay. Just wait.
Yes. Done. Hello.
Hello. Yes.
Done, sir.
Shall we move forward?
Yeah.
Just go to this question. So it's a very good question. Let's do this. So what they're asking is the following forecasts have been prepared for an investment of 20 million. This is the life of the project, and market size pessimistic, optimistic, expected. We are only supposed to take the expected outcomes, not required to take this too. Okay. And they have given some data with which we need to find out the cash flows. Okay. So first, what is the selling price they have given? 800. What is the cost they have given? 400. What is the fixed cost they have given? That is fixed 4 million, right? These are in millions, correct?
Yeah.
So first we will take revenue. 90,000 units, correct? Market size is 90,000 into 30%, 0.30 into 800 is the cost, correct or wrong? Hello?
Yes, sir.
I think the space, okay, we'll do this. So
Into
this is, sorry,
90,000 into 30%.
into 800. What is the answer? Variable cost. Also we will do 90,000 into 30% into the variable cost is how much? 400. If you can tell me the cash flows, I'll write it here. Fixed cost is almost 4 million. So 4,000. So 3 zeros are omitted, right? I'm just putting that 3 zeros omitted. And then depreciation. Depreciation is not a cash flow, but we'll calculate and keep it. So it's not a cash outflow. For depreciation, what they have said. For depreciation, they have said that 20 million is the investment. 20 million is the investment and it's for 8 years, right? So can you calculate and tell me how much is that?
25.
2,500. Okay. So depreciation. Yeah, that is what 3 zeros are omitted, right?
Okay.
So depreciation, if we into, can you do 35%?
8,75,000.
So this is the depreciation amount.
875.
Of this we are taking only, we are supposed to take the the cash savings, right?
Yes.
Cash savings 875 you got. Hello,
Yeah. Yes, sir. 875.
I'll just keep it like this. So depreciation amount and can you tell me the amounts here? I think this is 21,600 and for
Yes.
variable cost it is 10,800, right?
Yeah.
Fixed cost is taken and can you just add all this? This is revenue minus variable cost and fixed cost. Or
Minus.
else let us do one thing now. This, instead of getting confused, see what happens. We will remove the depreciation also. We are finding, we will find profit and from profit we'll find out cash flow. Is it right?
Yeah.
Can we do that? Hello?
Yes, sir.
There are two methods we can follow. Either we can take depreciation tax shield and keep this cash flow away. At last we can add, or else we will do right now. We will do right now for better understanding. 2,500 I'll take. Just tell me the pre-tax profit. From that you have to remove the tax. What are you getting, if you can tell? That into tax rate.
From 20 to 21,600, we have to
600
deduct all
plus
things.
minus 10,800 minus 4,000 minus 2,500. You will get 4,300. Okay. Less tax, 35%, 1,505. So you will get profit after tax. That is 2,795. Okay. Then
Okay.
we have to find out the net cash flow. We have to add back the depreciation. That is 2,500. Net cash flow is nothing but PAT plus depreciation, because we are concerned with cash flow, right?
Mm.
So it will be 5,295.
Yes.
Understood?
Yes.
So this is like you are going to get it for how many years?
5 years.
This is for 8 years, right? Fix. So 5,295 into present value annuity factor at the rate of 14% for 8 years. That is going to be 4.639
Mm.
minus the 20,
20 million. Mm.
yeah, 20 million. So you tell me what's the answer. The answer is going to be this. Just calculate, and any doubts you can ask me. You can just make a note of this.
From answer, we have to deduct investment 20
So,
million.
yeah, this is what is the investment you have done, right? 20 million. You have to deduct.
I got 24,563.505.
Yeah, yeah, yes. Done?
Yes, sir, done.
Yeah, okay. Next one. I'm just giving this as homework. If not understood, next class I will take this. Just for you to try. 38th question. If the present value of expected cash inflows from a project equals the present value of expected cash flow, discount rate is IRR, right?
Yeah, IR.
Yeah, just go for this question. So in order to increase production capacity, Gunning Industries is considering replacing an existing production machine with new technologically improved machine effective Jan 1st. Following information is being considered by Gunning Industries. The new machine would be purchased for 160 in cash. Shipping, installation, testing is 30. So it becomes 190, right?
1,90,000. Okay.
Machine is expected to increase annual sales by this much, and selling price, incremental cash flows include this much. This variable cost, fixed cost is given, and working capital investment is 35,000. They have given all the points using straight line depreciation. 5 years is the life, 40% tax rate. They are asking you, given the factors, gunning industry's net cash flow in capital budgeting decision is net cash outflow. So can I say this 2 plus the working capital what they are investing? Can I write this? Working capital is also initially invested, right?
Yeah.
Makes it how much?
Okay.
225,000, right? So the answer would be 225,000. The fact pattern was very big, but the answer was very simple. Just have a look through this. We'll move forward.
Right. For cash outflow, we are adding
Yeah,
all the
yeah,
things.
yeah. They're asking just the cash outflow. Next question. So Verla Industries is trying to decide which one of the following two options to pursue. Either option will take effect on Jan 1st of next year. Option 1, acquire a new finishing machine. Option 2, outsource the finishing work. So decision making has to be done in this case. Okay. So you have to first calculate the NPV in this case. Okay. And also in this case, we have to see. So the net present value of acquiring the finishing machine, how will you calculate? So, and they are asking, there is a trade-in allowance they will receive of 50,000, right?
Yes.
So trade-in allowance means since they are like buying the machine, they'll be getting this allowance. So immediately what we'll do, we'll remove this allowance from the asset cost. So asset is costing how much? Right? This will be depreciated for 5 years, right? So 950,000 by 5 is how much? 1,90,000 every year. Am I right or wrong? Hello.
Yes.
And the
From
cash,
1 million, we are deducting 50,000.
yeah, this is the depreciation.
Okay.
See, net pre-tax cash flows arising from savings in labor cost. So this is what is the cash inflow for them. They are saving this much in labor cost, right?
Mm. 1 lakh.
Yeah, and this savings, if I remove the tax from this, so that becomes 60,000. That means into 60% I will take, correct?
Yes. Correct.
And there will be like 1,90,000. This is the inflow, and 190,000 into 40% depreciation tax shield. What is the answer for this? I think 19 fours are 36, 76,000. Can I take this?
Yes.
This is also a cash inflow. This is from that saving. This is the savings from tax allowable depreciation. So your cash flows are how much? 136, right? That is for how many years? 5 years, correct? So now we will take the present value annuity factor at the rate of 10% for 5 years. So 136,000 into, what is that?
3.791.
How much will be that? 3.791, correct? Just multiply these two and tell me.
5,15,440.
5,15,440,
440.
right?
Hmm.
So we are just getting a negative NPV, right? Because 10 lakhs is what is the cost, and we got only 5 lakh 15. Correct? 950. Sorry, if we got 11s also. So there is a negative. So what's the difference? Negative value. Hello.
4,34,560.
I think it's coming around this. This is an outflow. You are paying from your side. Okay.
Okay.
Hello.
Yes, sir.
And we are not concerned with the outsourcing the finishing work. We are only concerned with this. Just make a note of all this.
Done. Done, sir.
Yeah. Next question. So firm that has a cost of capital of 12% invested in a project with an IRR of 14%. Okay. Cost of capital IRR. Expected project is expected to have useful life of 4 years. These are the inflows they have given, right? So they are asking initial cost of this project amounted to how much. First we'll so initial cost is nothing but NPV formula. NPV is what? Present value of cash inflows minus present value of cash outflows. Right?
Yes.
So what would we have? NPV. Then they give the NPV here? NPV we don't have, like 0. And outflow also we have got nothing, right?
No.
So what they have given to us, the discount factor, which is 12%. Firm has a cost of capital invested in a project with IRR of this. Project is expected to have 4 years life. Okay, okay. What they have given? This is different question. Foster manufacturing. We don't have NPV here. Nothing is given, and we don't have outflow here, but we have inflows here. Okay, we will do discounting of this. Let's see what we are getting. Uh, Initial cost. See, the point here is they have given NPV, right? IRR, right?
Hmm.
Hello.
14%. Yes, sir.
See, This is what is the trick they're playing. We can't discount them at 12%. Why? Because we know one thing. Invest a firm that has a cost of 12%. Invest in a project with IRR. See, IRR means what? The cost of
Yes.
capital at which your NPV is exactly equal to zero. Correct? Hello.
Yes, sir. Hello.
That is what. That is what. So we have put the NPV zero here. That means at 14%, if you discount, if that is the IRR, right? At 14%, if we discount, we'll get NPV as what?
Positive.
Zero.
0.
So the IRR of a project is the rate at which NPV is exactly equal to zero. So what we'll do, we know that at this rate, listen please, at this rate, our NPV is going to be zero. Just a second. See, at 14%, my NPV will be zero, right? Hello.
Yes, sir.
So at 14%, which is my IRR, my NPV will be exactly equal to zero. That means if I bring this outflow here, present value of cash outflow is equal to present value of cash inflow, correct?
Yes.
Yes.
Yes, sir.
And IRR is what? IRR is that rate at which NPV is equal to zero, or the present value of cash outflow will always be equal to present value of cash inflow, correct?
Yes.
Right?
Right.
So if I discount this at 14%, whatever the value I'm getting, that will be my NPV,
NPV. Yes.
right? Sorry, that will be my present value of cash outflows, correct or wrong?
Yeah.
Why it will be my present? Why will it will be my, equal to my present value of cash outflows?
Because
See,
NPV is equal to 0.
yeah, see. At 12%, if I discount, what I'm going to get, I'm just going to get my present value of cash inflows. But for me, they have asked the initial cost of the project. How to find out initial cost? See, they have given IRR. I know IRR is the rate at which my NPV will be equal to zero, or my present value of cash inflows will be equal to my present value of cash outflows. That's it. So if I know that when my present value of cash inflow is going to be present value of cash outflow at this particular rate, which is IRR, if I find out the present value of inflows, I can definitely say that is my present value
Present
of
value of
cash
cash out.
outflow. That's what.
Yes.
So you can just do the discounting here. 0.877, 0.769, 0.675, 0.592. Now you get 877, 1538, 2700, 2368. Now you add up all that, you get 7483. And this is your present value of cash inflow, right?
Yes. Yes.
Which is equal to your outflow as
Present
well.
value
So
of
your
cash
answer
out.
is this one. Yeah.
Okay.
You can note this down. And make important note you can put. So summary, next class I will do more 20 questions. In the sense I'll take more 2 sessions of this.
Okay.
Only on DCF, because this is the, see, maximum questions are there in this only. Other
Yes.
there are 20 or something like that. So if we take more 1 or 2 weekends, let's say 1 or 2 weekends, if we take 10, we can do half of that, and we can finish this, right?
Yes.
Yeah,
Half I'll
simultaneously.
try.
Sorry.
Half. Other half I'll try.
Yeah, of course. Done with this?
Yes, sir.
Yeah, okay. So today's we will check the status. So now there are some 79 questions. So I will do 30 out of this.
Mm.
We will do like 7 questions. This I'm going to finish of course, in the next class. 41 I have done. I have to do 55, 56 questions, right? So now some questions I need to do. This already we have finished. Okay, this we have finished. So next class my agenda will be to next one will be to finish this. First of all, I'll put a full stop to this. Then we will also do 7 questions. So simultaneously, these 3 sections will be done. Correct? Then we
Yes.
will touch 30 from this. We will take some 17 from this. Okay, and then some like 20 questions are there. So this two things like this 7 from this and some 20, 15, 20 from this will be done in tomorrow, day after tomorrow's classes. Okay, hello.
Okay.
And the
Okay.
coming weekend I will put full stop to this capital this investment decisions.
Sir, you don't
Then
share the payback period answers also and other
which one?
ratios ratio test you have taken, no, sir?
Okay. I'm sharing the answers. I'm sharing the answers right now within some
That
time.
one and payback questions also, sir, which I have tried. I need to just check
Payback
out the
answers I have to give. I have to give the answers.
yes, both.
Okay. You put a WhatsApp right now. I'm just immediately sending. Okay.
Oh, okay.
Okay, Samrit. Thank you.
Thank you.
Thank you.